Alright, stocks versus bonds in just a couple minutes. A stock is just a percent ownership in an equity. Typically, when we talk about them, we talk about equities as companies. So they're a percent ownership of that company, which gives you, the buyer, voting rights or just pure ownership for a return.
Anyway,
sometimes stocks will share profits through dividends where they give you some amount of money every quarter or every year. And the idea is you buy a share of that company to sell later because you expect its value to go up based on company expectations. Stocks and company values are pretty hard to predict, whereas a bond has much more known about it. A bond is just an agreement between two parties where one party agrees to pay another less money now for more money later.
what?
In addition to the face value, while the bond's active, the second party usually agrees to pay the first party some fixed amount of money on a time interval called a coupon payment. The first party's return on the bond is the face value they get at the end plus any coupon payments over the initial market value they paid for the agreement. From the perspective of the second party, even though they're paying the first party more than what they received, they got access to that capital earlier.
This actually may come in handy.
This means that they can use that capital for other stuff, make a return on it, and then give that money back at the end, which is hopefully less than whatever they spent it on. This is very similar to how a bank loan works, where the bank will agree to give you some amount of money in return for the same amount of money later with interest.
Coming up today.
From a stocks versus bond perspective, bonds aren't really talked about that much in our consumer market because they typically don't give higher returns, but they are considered much safer. This is because payments are pretty much guaranteed. They're contractually obliged, especially for risk-free bonds, which are backed by the US government. There are some private organizations and companies that issue bonds, but they have what's called a risk of default. This just means there's an inherent risk they won't pay you back in comparison to a safer issuer like the US government. For those interested, there's an entire grading system that compares the risk of default to the rate of return on the bond. The higher the default risk, the higher the return. And that's pretty much it. See ya.